Hey everyone, welcome to this explainer. Today, we're diving headfirst into the market dynamics for the week of May 24th, 2026. We're going to break down a massive structural divergence that is just ripping through global central banks right now. And perhaps more importantly, we're mapping out those critical geopolitical traps that could totally catch you off guard if you aren't paying close attention.
To do this, we're taking a real top-down approach today. We'll start with the holiday liquidity trap, look at the macro regime and geopolitics, and then break down the central bank divide. After that, we'll cover the weekly economic kill zones and wrap up with some high-conviction trading setups. Let's get to it.
All right, starting with Section 1, the holiday liquidity trap.
So the calendar is actually throwing us a massive curveball right out of the gate. You've got US Memorial Day, the UK Spring Bank Holiday, and EU Whit Monday all hitting at the exact same time to close markets on Monday, May 25th. Because these three huge financial hubs are offline together, Monday's market is literally going to be a ghost town. When volume just evaporates like that, it means incredibly thin liquidity, which leads to dangerous, wide, and super erratic spreads.
So how do we play this? Well, the rule here is strict professional restraint. Step 1, you only observe on Sunday night and Monday. Just watch the price action, but keep your powder dry. Step 2, wait for full Western liquidity to come roaring back on Tuesday, May 26th before you even think about executing trades. Seriously, don't initiate new positions early. Patience is absolutely your best friend when the institutional algorithms are unplugged.
Moving right along to Section 2, macro regime and geopolitics.
Right now, we're facing this massive geopolitical binary with the US and Iran nuclear talks, and the market is just completely suspended between two totally opposite outcomes. On the left side here, if a deal is reached, we'd likely see crude oil collapse, sparking a huge risk-on rally where riskier currencies like the Aussie and Kiwi dollars recover. But look at the right side. If things escalate or if talks fall apart, crude is going to spike. We'd see safe havens like the Swiss franc and Japanese yen surge, and equities would definitely take a hit. This binary is entirely running the show for oil prices right now, keeping crude super elevated. We're just neutrally observing this to gauge its mechanical impact on the broader markets.
Okay, let's head into Section 3, the central bank divide. This right here is what I like to call the engine room of the markets. There's been a really dramatic shift in tone from the Federal Reserve lately. Fed Governor Waller, who used to be a bit of a dove, literally said it's crazy to discuss rate cuts given the hot April CPI, PPI, and NFP data. This hawkish pivot from Waller is hands down the dominant macro narrative right now. It's driving the US dollar into a full-on bull regime, with money markets scrambling to price in a 25 basis point rate hike by year-end.
Just look at this matrix. It is the literal definition of structural divergence. At the top, you've got a hawkish Fed aggressively holding rates high, between 3.5 and 3.75%. That is on a total collision course, with a dovish, rate-cutting European Central Bank on row 2, which is sitting around 2.5%. Meanwhile, the RBA is hawkish and the RBNZ is just on hold. This specific divergence, especially that massive gap between the Fed and the ECB, is going to heavily dictate our primary trading plan for the week.
Which brings us to Section 4, weekly economic kill zones.
With the macro winds at our backs, we need to map out exactly where the volatility kill zones are hiding on this week's calendar. Tuesday kicks off with a tricky dual event, the RBNZ decision and Australian CPI. Wednesday, we get the FOMC minutes. Thursday brings US GDP. And then Friday is the absolute heavyweight, the PCE deflator.
Let's zoom in on Friday's key event. If the PCE inflation print comes in hot, it fully validates Waller's hawkish narrative and basically cements that rate hike. If it's cool, we might see a quick US dollar pullback and some risk-on relief. But here's the absolute biggest takeaway from this explainer. There is a strict blackout window between 1915 and 2000. You have got to avoid all US dollar pairs during this 45-minute window. This single data point is going to dictate the Fed's next move, and the volatility will just be way too dangerous to trade through blindly.
All right, finally, Section 5, top trading setups.
So, the million-dollar question. How do we actually translate all this central bank divergence into actionable setups? When we look at absolute currency strength, the Swiss franc is sitting pretty at the very top of the board with a score of +9. It's catching a massive bid right now on safe haven flows because of those geopolitical tensions. On the total opposite end, you've got the euro down at -8, just getting fundamentally crushed by the rate-cutting ECB. And then the US dollar is sitting strong in second place at +6. That extreme fundamental disparity creates our highest conviction setup for the week, a Euro CHF short. Our conviction here is sky high because it perfectly aligns an extreme technical downtrend with that massive central bank divergence we just broke down, and actively cutting ECB versus the incredible safe haven strength of the franc. The entry zone is tightly mapped between 0.9165 and 0.9175. We're looking at a primary take profit at 0.9110 and a secondary target stretching all the way down to 0.9060.
But hold on, a quick warning here. Risk management is everything, right? Since a lot of our top-ranked setups involve the soaring Swiss franc right now, you absolutely must cap your exposure to avoid concentration risk. The golden rule? Max 2 CHF pairs running at the exact same time and cut your position size in half. This prevents a macro trap, so that if a crazy geopolitical headline drops out of nowhere, it doesn't just nuke your entire portfolio.
Before you even think about clicking sell on that Euro CHF trade, or any trade for that matter, you need to run through this invalidation checklist. 1. Confirm there's no high-impact news dropping in the next 2 hours. 2. Ensure your higher timeframe bias is still totally intact. 3. Actively check those Middle East headlines right before the Tokyo Open. And 4. Wait for Tuesday's Aussie and Kiwi data to completely clear the system. We want to trade clean technicals, not chaotic headline noise.
As we wrap up this explainer, I want to leave you with this to chew on. With the highly consequential PCE data dropping Friday and global geopolitics literally on a knife's edge, will the US dollar decisively break higher and crush the rest of the market, or will this entire hawkish narrative completely collapse and trigger a massive structural reversal? Take a screenshot of that checklist, stay super disciplined during Monday's holiday trap, and I will see you in the markets. Trade safe.